tech-focused Silicon Valley Bank collapsed on March 10th after a run on deposits. This prompted regulators to step in with emergency measures to protect depositors, with the Federal Deposit Insurance Corporation, FDIC, confirming a successful transfer of deposits to a new bridge bank on Monday. SVB's collapse with $211 billion in assets is among the largest in history, and it followed fast on the heels of competitor Silvergate's voluntary liquidation. Here's a look at how SVB's closure is causing ripple effects across the crypto industry and what's to come. First up, while SVB was not perceived as crypto-friendly as Silvergate, the tech-forward bank had a number of crypto clients, especially hedge funds and venture capital firms. According to CoinDesk research, Circle, Blockchain Capital, Castle Island Ventures, Dragonfly, and Pantera all had relationships with the bank. In a recent regulatory filing, Pantera Capital listed SVB as one of 3 custodians for its private funds, alongside BitGo and the custodial service of crypto exchange Coinbase.
Friday, it became clear that Circle, which is the issuer of the USD stablecoin, kept a lot of its cash reserves in Silicon Valley Bank. They later announced that it was $3.3 billion. It was 8% of the $40 billion reserve. It was probably a bigger percentage of the cash reserve as opposed to the reserve held in US Treasuries. So this was a significant concern in the crypto market specifically as to whether USDC could survive a run.
Over the weekend, Circle's USD coin depegged from its intended $1 price, falling as low as 87 cents on March 11. By Monday, USDC had nearly regained its dollar peg after regulators announced on Sunday that depositors would be made whole. Algorithmic stablecoin DAI has also been knocked off its peg and hit an all-time low of 88 cents. Notably, DAI is collateralized by holdings from MakerDAO, which include USDC. USDC's depegging from $1 was a sign that investors worried about Circle's reserves that were stuck in SVB.
Stablecoins have a long history of depegging. Stablecoins are supposed to be around the price of $1 or whatever fiat is pegged to. Doesn't necessarily always have to sit there. Yes, historically, a lot of times if it goes off that dollar line, it normally nukes to zero pretty quickly. But in the case of reserve-backed stablecoin like USDC, there wasn't like a high chance in my mind that this thing was going to zero.
A Circle spokesperson told CoinDesk on March 10th that Silicon Valley Bank was one of 6 banks that managed the approximately 25% portion of USDC reserves held in cash. Others included Bank of New York Mellon, Citizen Trust Bank, Customer Bank, Silvergate Bank, and Signature Bank. By March 12th, the crypto-friendly Signature Bank was shut down by state regulators. This marks the 3rd bank collapse in 1 week. A joint statement from the Federal Reserve, FDIC, and U.S. Treasury Department said all depositors who used Signature would also be made whole. The federal regulators outlined actions to protect depositors in SVB in the same statement. Signature's sudden failure leaves a key part of the crypto industry's back-end infrastructure in limbo. Signet, a blockchain-based real-time payment system that's supposed to work 24/7. Circle, Coinbase, and many crypto trading firms used Signet. With the shutdown of Signature Bank, the fate of Signet may prove to be important for crypto firms that use it for real-time payments and settlement. So, what's next? In the wake of the Silicon Valley Bank and Signature Bank collapses, US President Joe Biden ensured that depositors in the failed banks would be made whole. He adds that senior management at the banks would be removed and that investors in the banks will not be protected.
They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Following a tumultuous weekend, depositors of SVB now has full access to their money in the new bridge bank that will be operated by the FDIC.
Around 85% of depositors held money in accounts that were not FDIC insured, but FDIC came in and said, don't worry, we will save you. And basically, without FDIC insurance, it means that without federal action or purchase of the bank, those funds could be irretrievable, but FDIC came in and is saving everything.
While the federal government supported depositors to access their funds this time, Biden is calling for stronger banking regulations.
We must reduce the risk of this happening again. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.